What's up, everybody? Welcome back to the Stocktrades YouTube channel. My name is Dan Kent, and I'm here to deliver more great ETF videos this week. This video is going to go over some of the best index funds here in Canada. These are broad-based index funds. Previously, we've gone over dividend ETFs and more recently REIT ETFs, which actually didn't really garner that much interest, which actually surprised me. But this video I think is going to be huge. You're going to love it. I'm going to be going over 5 of the best index funds here in Canada to not only get you exposure to the markets here in Canada, but the last 2 are going to go over some international and some US exposure. One of them is my favorite ETF and is a major core piece of my portfolio. So you are going to want to stick around till the end of this video. But 5 great Canadian index funds, index ETFs coming at you right now. So before we start the video, remember, smash that like button, subscribe to the channel, and I know this is a video on index funds, Canadian index funds and ETFs, but we are individual stock pickers over at Premium. We do it for thousands of Canadian members. If you want 3 free stock picks, head down below into the description, sign up for Stocktrades Premium, absolutely free, no credit card required. You'll get 3 of our foundational picks, model portfolios, access to some of our screeners, things like that. Absolutely free. But let's get into our first Canadian index fund. It is an iShares product and it trades under the ticker XIC. So if you want the broadest exposure to the Canadian economy, to the Toronto Stock Exchange, XIC is likely going to be the ETF that you want. If we look to its holdings, we can see that some of the largest companies in the country are in the top 10. This is because this is a market cap weighted ETF. As we can see, Shopify, Royal Bank, Toronto Dominion Bank, Canadian National Railway, these are all the largest companies in the country. Shopify overtook Royal Bank last year and has remained the largest company in the country. But other than that, the top 10 of this ETF is going to be dominated by financials. We can see here Royal Bank, TD Bank, Bank of Nova Scotia, Bank of Montreal. The only big 5 bank that is not inside of the top 10 of this ETF is Canadian Imperial Bank of Commerce. Then we see massive property management firm Brookfield Asset Management, one of the largest pipelines in Enbridge and TC Energy, both railways in Canadian National Rail and Canadian Pacific Railway. And if we look to this ETF, it has arguably the largest sectors by economic moat here in Canada. Our pipelines are very dominant in terms of market share. Our banks are some of the best capitalized financial institutions in the world. And our railways are probably some of the most dominant companies in North America. The only thing that this lacks in the top 10 would arguably be a telecom. So if we look to the 5-year results of XIC, we can see that this index fund has essentially tracked the TSX perfectly, a minor outperformance. And this shows that XIC is arguably the easiest way for you to gain access to the whole Toronto Stock Exchange. So last but not least, if we take a look at yield and fees, this is an index fund that is practically free to own. I mean, it's going to cost you 50 cents per $1,000 invested at expense fees of 0.05. So summing it all up, XIC yields around 3%, has expense ratios of 0.05%. Its largest sector in terms of exposure is financials at 29.61%, and then materials at 12.93%, which makes complete sense because of the overall structure of the Toronto Stock Exchange. And its largest 3 holdings are Shopify, Royal Bank, and Toronto Dominion Bank. Let's move on to our next Canadian index fund ETF, which is a little more of a narrow exposure. It focuses on only the 60 largest companies on the TSX, and this is actually one of the oldest index funds on the stock market. So interestingly enough, the TSX 60 ETF XIU was the first ETF ever created. It started trading in 1990, and what the ETF aims to do is track the overall returns of the TSX 60 index, which essentially contains 60 of the largest companies here in Canada. And if we look to the overall holdings of this, we can see that it is much the same as XIC. We can see that Shopify makes up the #1 position, followed by Royal Bank, Toronto Dominion Bank, Canadian National Railway, although the weighting towards these stocks is a little bit different, primarily because this ETF only holds 60 companies. So it does have a little larger makeup, mainly because it doesn't have that back end of smaller holdings. This only contains the 60 best. In terms of average volume, this is arguably one of the most liquid ETFs in the world. It has around 2.7 million units traded every single day. It is very liquid. You will have no problem buying and selling this, much like any stock on the exchange. And it is a great option if you're looking for exposure here in Canada. Now, is it the best option? Not exactly. I would much prefer XIC just because of the lower fees, and you'll see in a sec here when I get to the performance that there actually isn't much difference in performance between these two. If we look to the yield of XIU, it's essentially identical to XIC, except that the management fees come in at 0.15%, meaning you will pay $1.50 per $1,000 invested, where XIC was 50 cents per $1,000 invested. So although the bulk of the makeup of these ETFs is the exact same, except with this TSX 60 index not having that back end of smaller holdings, the yields are the same, the performance is actually almost identical, but the management fees are more for XIU. So to sum it all up, we have the TSX 60 index. They have a yield in and around the 3% range. This ETF's goal is to track the 60 largest companies in Canada, and the top 2 holdings sit with both Shopify and Royal Bank. And the ETF has outperformed the TSX index by a pretty wide margin on a dividend adjusted basis over the last 5 years. But now that we're done the broad-based index funds here in Canada, let's move on to a little more aggressive growth options. And our next one is XIT, which aims to track the technology index here in Canada and has posted some pretty crazy returns over the last 5 years. So before, it used to be if you wanted huge tech exposure, you had to go south of the border to the United States. But the landscape is changing, and we're developing more and more strong technology companies right here in Canada. And in fact, we have arguably one of the most successful stocks in North America over the last 5 years, which is Shopify. They've returned over 6,700% to investors over the last 5 years. And as you've noticed in the last 2 index funds here, Shopify is the largest holding. So we are going to go 3 for 3. So if we look at the holdings, the top holdings of XIT, this is an index fund that aims to track the S&P Cap Technology Index. So the top holding is, again, Shopify at a whopping 29.85%. The second holding being Constellation Software at 21%. The third holding, a relatively unknown but pretty large blue chip tech play here in Canada, which is CGI Group. Then you have OpenText, BlackBerry. You have a newer player to the scene in Lightspeed Point of Sale. And this also contains some pretty strong dividend growth options in Enghouse and OpenText. But interestingly enough, this ETF does not pay a dividend. It opts for the pure capital appreciation route. And if we look to results, this has been an ETF that has outperformed significantly. And I've actually spanned it out a bit to include the S&P 500 and the NASDAQ. And as you can see, this is a ETF that is outperforming those indexes as well. So a very small ETF here in Canada is outperforming some pretty major indexes. And there is no question that a large part of this is due to the performance of Shopify. When you have a stock with this heavily of a weighting inside of this index fund, it is going to cause its performance to to launch. And if we go back to the holdings here, we can see that a purchase of XIT is a bet on the 4 biggest tech companies here in Canada: OpenText, CGI, Constellation, and Shopify. If we go down to the bottom of the top 10 holdings, we can see that Celestica only has a 0.84% allocation. So some do argue with this index fund that you could essentially buy the top 4 within this ETF and just save yourself the fees. But it has realized some pretty nice returns from companies like Kinaxis and Lightspeed Point of Sale. This is an ETF that is likely going to have more and more tech companies placed into it as they IPO and become more stable here in Canada, so it's one that you should definitely look at moving forward. Again, this index fund does not pay a dividend, and it has management fees of around 0.55, which means you will pay $5.50 for every $1,000 invested. This is a higher management fee. You'll see this when you get into more particular niche ETFs, niche index funds. They tend to charge higher fees because they are more actively managed than, say, a ETF like the TSX 60, which only has to rebalance when the 60 companies shift, or XIC, which essentially holds the broader index. There's a lot less work put into those ETFs, and as such, the fees are significantly lower. So overall for XIT, it aims to track Canada's largest technology companies. It does not pay a dividend, and it has management fees of 0.55%. And obviously the largest sector allocation in this ETF will be technology. It aims to essentially be a pure play on Canada's tech. So now that we're done with XIT, let's move on to our next Canadian index fund, which is actually an international play. It's arguably the most popular Canadian listed ETF that can give you access to the United States. So this is definitely one you're going to want to listen to, and they trade under the ticker XUU. So for Canadians, if they want to get exposure south of the border, they have to do a few things. They either have to convert their Canadian to US dollars and buy individual stocks, or they could convert their Canadian to US dollars and buy US listed ETFs. Or if you want exposure, true 100% exposure to the United States, you look to XUU. And why is that? Well, XUU essentially aims to give Canadians a one-click option for owning the entire US stock market. Now, this ETF in terms of fees, and I'll get there soon, is a little bit unique, and the fees you think you're paying might not be exactly what you're paying, but first, let's have a look at the holdings. So this ETF essentially carries other ETFs inside of it, and this is why the fees are going to be a little bit different. But we look at the iShares Core S&P ETF, which is essentially the best way to get exposure to large established US companies. This is a low-cost ETF that contains 500 of the US's largest companies. If we look to holdings, we can see some of the top holdings include Apple, Microsoft, Amazon, Facebook, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, JP Morgan. So this is the bulk of XUU. It is an underlying ETF that contains the 500 largest companies in the United States. If we move down, we see the iShares Core S&P Total US Stock, which is essentially a total market ETF. It gives you exposure to the US stock market, ranging from some of the smallest to the largest companies. And if we look to holdings again, you're going to see much of the same. Apple, Microsoft, Amazon, Facebook, Tesla. Then as we move down the list, we're going to see the iShares Core Mid Cap ETF. Now this is a relatively small weighting at 4.77%, but it still is going to give you exposure to US mid cap stocks. And if we look to the holdings, we have Generac Holdings, Solar Edge Technologies, Penn National Gaming, Caesars Entertainment, Biotech, PTC Corp, Charles River Laboratories. So this is not your typical US names. And if we continue to go down to the final holding, which is the S&P Small Cap ETF at 3.11%, this is going to give you exposure to a ton of US small cap stocks. And again, if we look to these holdings, I actually know very few of these companies. So that just shows you they're all US small caps. We can see the largest holding in here has a weighting of 0.77% and a market cap of around $507 million. So with all these underlying ETFs, you're going to gain exposure to essentially the whole United States market. And this is an insanely popular ETF. Now, management fees are 0.07%, but it's very important to understand that there is underlying ETFs that contain US stocks in this portfolio. So even if you hold it in an RRSP, you are subject to withholding tax. So although the fees are 0.07%, you will pay north of 0.3% or $3 for every $1,000 invested to invest in this index fund, which to me is still insanely cheap to get one-click exposure to the United States. So in terms of performance over the last 5 years, XUU has returned 116.2%, while the S&P 500 has returned 137%. But this isn't exactly a dead accurate performance measure because this S&P total US market index contains many more companies than the S&P 500. 116% returns over the last 5 years is still very impressive. So summing it all up, XUU, the easiest way to get exposure to the United States. The index fund yields 1.33% and has management fees of 0.07%, but be aware that you will pay extra withholding tax for holding US ETFs in this index fund, even though it trades in Canadian dollars and even if you have it in an RSP. Its top sector allocation is the IT sector at 26.74%. After that, the healthcare sector at 13.33%. And its largest holding is essentially an underlying ETF that aims to track the 500 largest companies in the United States under the ticker IVV. But moving on to our next and last index fund, which is my absolute favorite, and that is one that covers the entire globe except Canada, and that is XAW. So what exactly is XAW and why is it one of my absolute favorite index funds and one that makes up a huge chunk of my overall portfolio? Well, that's because this is essentially a global ETF. It holds companies, has exposure to markets that are essentially a global scale. But the one thing about this is it excludes Canada. So while I sit and make individual stock picks here in Canada, I let XAW get my international exposure in a single click. And typically we would look at the holdings right now, but the first thing that I want to show you is essentially their exposure to each country. So the one reason I highlight that this is still strong exposure to the United States is because it still has 57.91% at the time of filming exposure to the US. And then if we move down this list, we can see 7.3% to Japan, 5.3% to China, 4% to the United Kingdom. We have France, Switzerland, Germany, Australia, Taiwan, Korea. And this ETF really does give you exposure to any market in the world, and that is why it has performed so well as well. If economies are struggling here in North America, you still have exposure to the global economy, essentially. That is the point of this ETF. And if we do look to the holdings, we will see that the number one holding in this is also the iShares IVV ETF, which is the ETF that tracks the 500 largest companies in the United States. But then we move down, we have some emerging markets ETFs, we have those small cap and mid cap ETFs. This is essentially XUU with global exposure, which provides just more broad diversity for Canadian investors. So this is designed to be a long-term holding. This really isn't something you buy and sell. This is something you purchase in your portfolio and simply set it aside and let it do its thing. And if we look to the performance of the ETF, it has done just that over the years. The ETF does have double-digit annualized returns, and as you can see, since it started out in 2015, it has returned 81.9% to investors on a dividend-adjusted basis. So overall, the ETF yields 1.49% right now and has management fees of 0.2%, or $2 for every $1,000 invested. And yes, this is a little higher management fee than the Canadian ETFs we spoke about earlier, but 0.2%, $2 per thousand invested to literally gain exposure to the global economy is something that is well worth the cost, and this is something that is just going to sit in the background of your portfolio and just generate long-standing returns. We can even look to the performances of the major indexes during the stock market crash of 2020 and see that XAW outperformed them all. So this is somewhat of a cushion to overall market volatility. So to sum it all up, XAW, they have a yield of 1.49%, management expense ratio of 0.2%, and if we look to the largest sectors, the IT sector makes up nearly 21% of the fund as well, and consumer discretionary 13.76%. So everybody, really hope you liked the video. Hope it wasn't too long-winded. I tried to speak on these as quick as possible, but also go as in-depth as possible, especially considering some of these own underlying ETFs. So it can get pretty complex as to what the actual holdings are. But these are, in my opinion, some of the best Canadian index funds, not only for exposure to the TSX index with XIC and XIU, but also Canada's technology index, which I feel will outperform moving forward in XIT. But you also get US exposure with XUU and global exposure with XAW. All of these are pretty low fees, except maybe XIT, but XIT over the last while has been more than justified in its performance. But again, smash that like button, make sure you head down below and subscribe, and also you have to drop a comment down below. Let us know how you're liking the videos. We only make videos that you want to watch, so what do you want to see next? Let us know in the comments, and I'll see you next time with more great Canadian content.